Good morning, everybody, and welcome to our third quarter webinar. I'm going to specifically focus on a few macro issues. I'm going to look back at our views that we have communicated with you over the last 18 months. And then very importantly, I want to go back over the last 70 years and look at how asset classes performed and see what lessons we could learn from that to try and understand how the future would unfold. And then finally, I would like to conclude with a few South African equity ideas that we think is quite pertinent to understand at this particular point in time. Looking back at what we said over the last 18 months, I think it's just important that we highlight a few of the important themes that we discussed, look at our views that we had, and then be very honest with ourselves in terms of whether we got the theme right or wrong, or whether it was partly right or wrong for that particular period. Because most of the tilts or the positioning in our portfolios was based on the views that we had over this particular period. So the first and most important point that you would have seen in our portfolios was that we favored South African equities. And the main reason for that was we thought that despite the negative macro story associated with South Africa, we still thought that the particular asset class was cheap and that most of the bad news was priced into the asset class. So if you look at the performance of South African equities, it outperformed global equities over this particular period. And again, the key was really that the asset class was cheap enough, and that provided comfort for us and was certainly aligned with our investment philosophy that we would tilt portfolios aligned with where we see valuations favor us. So that has worked quite well for us. We were quite cautious about global equities, and the caution really came in towards the second half of last year, where after the phenomenal recovery that we've seen in global equities following the material stimulus that we've seen from both monetary and fiscal authorities overseas, in the second half of last year, we thought that the asset class became too expensive. There was a lot of hype in the asset class, and despite the good story associated with earnings in particular, we thought that it was all priced in, and we were concerned that should you get any negative news, that the asset class might start to underperform. As it turned out, global equities underperformed materially, and from November to the lows that we've seen being recorded at the end of June, the Nasdaq lost about 30% of its value, and the S&P, which is the broader index in the US, lost about 20% of its value. So the view certainly came true. We might have been a bit too early initially, but we knew where the risks were stacked up at the time. We thought that local bonds, again, despite some negative views on the fiscal situation in South Africa, that global bonds were quite cheap. The yields were attractive to us, and we favored that in our multi-asset portfolios as an asset class. We thought that we should carry the overweight position. As it turned out, global bonds did well. The yields provided a big enough margin of safety. And in fact, if you look at the last year, it was probably the best performing asset class across a wide range of assets that we've seen. Offshore bonds never made sense to us. The reason why that was the case, if you go back particularly to the period in early 2020, there was an enormous amount of fear around in terms of financial assets, and global bonds were viewed as a so-called safe haven asset class. And in fact, at the time, if you would have bought a 10-year European bond, it would have yielded minus 0.6%, which simply means that if you held that particular asset for a 10-year period, you were guaranteed to generate or get a return of minus 0.6% per annum over a 10-year period. For us, that didn't make sense. Since we being long-term investors, we thought that there were better value elsewhere in other asset classes, and therefore we avoided the asset class. That worked very well for us. Then maybe the last 2 points that I would like to highlight. Firstly, we thought that the rand was too cheap, that the rand should behave well. As it turned out, it did exactly that. But over the last 5 months, the very strong dollar leaned on the rand, and as a result, the rand was underperforming, and to our mind is now even more attractive or cheaper than it was 5 months ago, But if you look at our view, no, only partly right, but we stick with that particular view, given the fact that we just think that the dollar, for very good reasons, but is very expensive at this particular point in time. And then maybe the most important point that I would like to touch on is the second last point on the slide, and that is that inflation is probably the most crucial variable that we need to understand. And we thought that inflation was picking up as a result of the energy crisis, followed, boosted by the war that we've seen between the Ukraine and Russia, or Ukraine and Russia. And as a result of that, we've seen that the inflation rate in the US at the moment, around about 8.1%, in the UK, double-digit numbers, and even in South Africa, we're talking about an inflation rate of about 8%. Of course, initially, the monetary authorities thought that the inflation phenomenon was a transitory one. We disagreed with that, as it became quite clear that second round impact should come through in the market, and that monetary authorities at some point should respond to that. And that is exactly what has happened. We've seen that the Federal Reserve in particular was quite hawkish, and that the interest rate hikes that we've seen coming from the Fed, certainly much higher than what the market expected. In this week, we are likely to see that the ECB, or the European Central Bank, is also to hike interest rate by 75 basis points. So that view, of course, turned out to be the correct one. And that view, of course, is going to be extremely important for the direction of asset classes, both equities and bonds, and in fact, commodities going forward. So with that as some background, you will understand why we tilted the portfolios in a particular way, and why the performance, certainly on a relative basis in our multi-asset portfolios, was very decent over this particular period, because I think on balance, we got most of those big themes right. But that is the last 18 months. I think it is important that we do have a look at what has happened to the performance of equities, and in this case, I'm going to focus on equities listed in the US, the S&P 500, how that performed over various decades, over the last 70 years. And the reason why I want to do that, I just want to highlight one or two points, because I think it is important that we learn from history. Now, the first point to make is, if you look at the performance of equities over the last 70 years, if you look at the average, that was the asset class to own, because out of the last 70 years, only 2 decades gave you negative real returns. But for most, we had pretty spectacular performance from equities globally over this particular period. First point to note. Second point to note, more often than not, when we had negative returns coming from the equity market, and that happened during the period of the 70s, and it also happened in the period from 2000 to 2009, the starting point was extremely important. In both cases, when equities underperformed for the particular 10-year period or decade, the starting point was high. So when we think about the future, it is important that we fully understand whether the starting point is high and low, because that will drive prospective returns. And then the third point to make is growth does matter and inflation does matter. And if you look at the 1970s, I think it is extremely important that we focus on that, because the 1970s was the period where, for the first time in the early 70s, we saw double-digit inflation coming through in the United States and, in fact, in the rest of the world. We had a particular response from monetary authorities where they said, well, the cure to inflation should be to hike interest rates. As a result of that, those higher interest rates created headwinds for economic growth. Earnings came under pressure, and of course, equity markets didn't like that. However, if you break the 70s down, there were actually 2 periods of high inflation. The early part, and then again in the late 70s, was characterized by high inflation. And in both cases, the initial stimulus came from an energy shock. But if you go to the late 70s, for the first time, we've actually seen that a guy with the name of Volcker took over as the chairman of the Fed, and he said that I'm going to nip inflation in the bud. And in order to do so, he had to hike interest rates to 18%. I'll repeat that, 18% at the time, to get inflation under control. And that created the basis for very strong equity performance during the 80s and the 90s. If you look at where we are today, we have a similar problem. We have inflation picking up, certainly not double-digit numbers in most of the world, as I mentioned, certainly in the UK. But the inflation initially came as a result of an inflation shock. Secondly, another factor that drove inflation was the fact that after COVID, we've had enormous stimulus, both from a fiscal perspective and from a monetary perspective, where interest rates went to zero, that drove demand. And on top of that, we had supply side bottlenecks that drove inflation higher. If we don't nip it in the bud, then the risk is that inflation will pop up in another form later on. And again, it will lead to the similar kind of events that we've seen in the 70s. The one thing that I have got to warn, though, is that I don't think the current situation is exactly the same as the 70s. If you go back to the 70s, inflation expectations were entrenched in the thinking of participants in the economy. Since inflation has been a 2-year phenomenon so far, or maybe an 18-month phenomenon to be more precise, we don't think that the inflation expectations are entrenched in the system yet. So maybe we don't need the same harsh treatment from central banks to get inflation under control, and maybe we are not going to see such strong action by central banks over this particular point in time. So to look at the future, bear in mind what I've just mentioned, and then we just say, to give you a very simplistic view into the future, it is just important to think about the variables that will drive future. The first thing is we are at mercy in the hands of politicians and policymakers. Politicians will drive policy, and based on the policy, one would expect business leaders and consumers to respond to whatever comes from the decision makers. For instance, if interest rates go up, you must understand that that acts as a headwind for economic growth. Business leaders will shape their spending and investment pattern to survive in a period that might be tougher. And similarly, consumers will also shape their spending patterns based on how they view the economic environment. If interest rates are higher, of course, the willingness to spend and, of course, the ability to create credit for themselves will be tougher. And therefore, you can expect economic activity to come under pressure as a result of that. And then finally, you've got to pull the activities in the actual economic sphere, you've got to pull that through into financial markets, and it will be the investors and the traders' interpretation of what business leaders and what consumers will do. Their interpretation will ultimately be very important in terms of how the different asset classes will be rated by investors and traders in the longer and, of course, in the shorter term. So that is just as a background. So you've got to understand these three broad trends if you want to shape your view for the future. I think it is true to say that given the current phase of the interest cycle we were in, that there's a lot of uncertainty at the moment. That is the first point to make. Secondly, it is also very important that should the macroeconomic environment change, that policymakers and politicians might quickly change the direction of which they want to drive the economy. And since they don't have 2020 vision on the future, we can expect them sometimes to surprise the market. And that is why we say we think that at this current point, that the visibility in terms of financial markets are quite poor. So what are the potential economic outcomes that we think we can see over the next 18 months to 2 years? We think that there are, in essence, three possibilities. The first one is a soft landing. In other words, we see higher interest rates, but that the authorities, despite the fact that push interest rates up, can fine-tune the system to such an extent that economic growth slows down, but that we don't experience a recession. We assign a very low probability to that, let's say 20%. What normally happens when interest rates go up, and in this case, of course, interest rates go up because economic activity is quite strong. And of course, we want to curb inflation. What normally happens, interest rates, you get an overreaction from the central banks, and the high interest rates act as a headwind, and ultimately economic activity goes into recession. We attach quite a high probability to that, 45%. But I think it's also true to say that we don't expect a deep recession. And the one reason why we do that is that we think, or why we have that view, is that we think that because the labor market is still pretty firm in the US, that the consumers is likely to be quite resilient in the US, and therefore we don't think it's the hard landing will be a deep recession like we have seen, for instance, in 2009. And then lastly, there is also a probability that we might enter a period of stagflation. What is stagflation? Stagflation is a period where you have kind of mediocre but positive economic growth, but you can't get rid of inflation, and you have a kind of a boom-bust outcome in terms of economic growth and inflation, similarly to what we've experienced in the 1970s. So you can see we've assigned a probability of about 35% to it. I think the political will be key in terms of the probability that we can assign to this potential economic outcome. If the central bankers are prepared to do the unpopular thing and nip inflation in the bud, then this particular outcome will have a lower probability assigned to it. But if the central bankers are going to act like politicians, that they're not prepared to pay the price to nip inflation in the bud, then that 35% is quite a likely outcome in our view. Okay, so what is the main difference and what is the big threat for us? As I said right at the beginning, it will be how inflation is going to respond. So if you look at this particular graph, you will see the blue line is inflation, and it goes back to the 1970s in the States. And the black line is the Fed funds rate, or in other words, simply interest rates in the States. So go back, let's just go back to the period of the early 70s. You will see in the early 70s, inflation was around about 3%. And then as a result of the oil shock, inflation went up to about 12% in the States. The black line for that period, unfortunately, our database didn't give us the data for that, but interest rates started to go up. But if you look at the late 70s, that is the important part. Inflation went up to about 14%. Volcker came in, said, I'm going to nip inflation in the bud, and interest rates, the black line, went up to 19% at the time. And as you can see, of the sustained high interest rates, the blue line inflation rate came down, and by the early 80s, we saw inflation back at the 3% level. Fast forward to where we are now. If you go to the far right, inflation sits about 8.2%. Interest rates sitting at about 2.5%. So interest rates at this particular point in time, in real terms, negative 5.5%. So in short, the central banks don't have the luxury what they had in 2009, or the luxury that they had in 2020 to stimulate the economy when economic activity came under pressure. Because interest rates in real terms are extremely low. Or putting it differently, in real terms, it is deeply negative. So if inflation comes off to 3.5%, which is the expectation over the next 12 months, even so, interest rates are still in negative terms. So we don't have the firepower to provide the stimulus to economic activity should economic growth come under pressure, because inflation is a major deterrent for that. And I think that makes this particular cycle different to what we've seen in 2020 and different to what we have seen in 2009. So there are obviously some potholes that we need to negotiate when we position portfolios, but as normal, we pay attention to price. So a lot of the negative news that I've explained now, the good news is that not a lot of that is new. Most investors and market participants are being confronted with the same picture that we've been confronted with. And normally markets are forward-looking. And if you look at the prices of global equities, which is reflected in this particular slide, which is the so-called price earnings multiple of the MSCI World, you can clearly see that the decline that we've seen in the rating of the market has been actually quite significant. If you go back to 2021, you can see that MSCI World traded on a price earnings multiple of 35 times. That has declined now to a multiple of 17 times. That came as a result of two factors. Firstly, the sell-off that we've seen in global equities since November last year. But secondly, despite the fact that equities actually sold off, the earnings in this particular period was quite strong. So the denominator went up, and of course, the price came down as a result. The equity market, the rating of the equity market came down significantly. It is still not dirt cheap. And I think that is the important point to make. But for stock pickers, and that is who we are, and that is who we think we are when we talk about our global high-quality team in London, within this environment, you've seen an indiscriminate sell-off in equity prices. And for stock pickers, it does create the opportunity to find good assets at much better valuations that they can build into the portfolios. So market has taken a big knock. Certainly not the bubble is the froth is out of the market, but still the environment quite negative. But for stock pickers, it looks quite attractive. If we look at the South African market, and if I may share one or two things on the South African market, we've seen exactly the same pattern. So we've also seen a significant derating from the 2020 to the current levels, where our market is trading at a historic price earnings multiple of less than 10 times. Now that is cheap. It takes us back to 2020 in terms of valuation. It takes us back to 2009 in terms of valuation. If you cast your eye to the far left, you will also see the only time when the market was really cheaper than where we are now was during the emerging market crisis back in 98, 99. So from a valuation perspective, we take heart that, again, the market has, to a large extent, discounted the negative news that we have experienced globally and also, of course, in South Africa as well. Again, if I can bring it down to the equity level, I think it is important that we must say that if we just take a basket of high market cap shares in our market, we look at the average valuation of those shares over the last 10 years, and we compare the current valuation with the average valuation over the last 10 years, out of these shares, there are only one share that is trading at a premium to the average valuation of the last 10 years, and that is Capitec. The rest of them, all of them, are trading at a discount to that average valuation, and in most cases, at a significant discount to the valuation over the last 10 years. So for us as stock pickers within this basket, we clearly get some comfort that despite the arguably negative story from a macro perspective, that the market has been quite rational and factored that into the prices. Being long-term investors, there's more than enough opportunities for us to have comfort in the valuation of these shares, and we believe that patience will be rewarded if we buy into this particular asset class. So I think very important to note that. Then if I just want to make one other comment before I hand over to Hannah, and that is, we always talk about equities because, as I've said right at the beginning, when you look at historic returns, it is by far the asset class of choice in terms of longer term returns, but it does come with a lot of volatility. A lot of our clients also give us multi-asset mandates to manage portfolios, and therefore we've got to look at the other asset classes. Focusing on South Africa, and it's a point that we made right at the beginning, we just said that if you look at South African 10-year bonds, or South African bonds as an asset class, if you look at the 10-year bonds, you will see that these bonds are trading at yields of more than 10.5%. Given our current inflation rate, that is a significant real return in the actual yield. And that is why, as an asset class, in the longer term, we think that most of the negative news associated with this, with the South African fiscal story, is priced in. And just as this particular asset class provided pretty decent returns over the last 18 months for our clients, we think in the investment cycle going forward, this asset class still deserves a proper place in a multi-asset class portfolios given these yields. And we continue to stick with this particular view. So ladies and gentlemen, just to summarize, I think the outlook remains uncertain. There might be different outcomes. If there's high uncertainty, then I think we need to make 2 points. In a multi-asset portfolio, we need to diversify and diversify properly. We need to bring in assets in a portfolio that are uncorrelated. What does it mean? It means that the one asset will act as a buffer if another asset does not perform. Given the uncertainty, that is the strategy that we will employ in these portfolios. I think volatility is going to stay with us. And then even if we talk about equities, the South African equities, the market remains attractive to us. The outlook is uncertain, but in that equity portfolio, just as an overall multi-asset portfolio, it is important that we also make sure that we diversify properly across the various sectors to ensure that we don't have all our clients' egg in one basket. And then finally, from a global perspective, given the sell-off that we've seen in markets, the consistent uncertainty that we've seen in markets, that is starting to create opportunities for our global equity colleagues in London, and they will take us through in terms of their views as far as that asset class is concerned. So from my side, thank you very much. There's 3 months left in the year, and let's hope that the sell-off that we've seen in markets can turn into a more braver appetite from investors, and that we end the year on the front foot. Thank you very much.
Hello everybody, it's lovely to be here. My name is Hannah Gooch-Peters. I'm a global equity investment analyst working in Sanlam UK. I work closely with Peter Free, who is the fund manager of the Global High Quality Strategy. I'm looking forward to speaking to you today about the performance of the Global High Quality Fund, and also some of the recent dislocations and things we've seen in the market that has caused both the outperformance of the fund this year, putting us in the top 1% of our global equity peer group, and also the certain headwinds and things we've seen in the market over the past 2 years post the pandemic. So thank you very much to Alvain for setting the scene, and I will go on to talk through some of the things we've seen in the market with you today. So first of all, I'd just like to start with the performance of our Sanlam Global High Quality Fund. This goes back to its inception back in February 2014. It's been a very pleasing outcome over the long term for us, and for you as clients in terms of performance. You'll see there, first of all, I'd like to point out that the blue line is ourselves. You can see the recent drag on performance on a relative basis versus the market, which is that dark grey line over the past 2 years. And that's what I'm going to go into today in the presentation, to talk about some of the very extreme and quite volatile environments we've seen over the past 2 years with the pandemic, and why we've chosen to not participate in the euphoria we've certainly seen through much of 2020 and 2021, but also how we've very much managed to protect on the downside this year, and we haven't participated in that big pullback we've seen in many parts of the market this year. But if you look at us versus the orange line, which is the global peer group, you'll see there that we've behaved very, very differently to our average global equity fund over the past 8 years. Now, if we just look in terms of calendar year returns, as I said, you'll see there we did underperform the market in the years of 2020 and 2021. The total return since inception of the fund, this is US dollar performance, works out at 8% compound per annum. This is very much in line with what Peter said when he launched the strategy, actually 10 years ago, just a couple of days ago. So we've just seen our 10-year anniversary. But in terms of starting points of valuations, we thought that was very much in line with what would be achievable. This translates to 14% compound returns in rand per annum. So we think that's a very pleasing result in terms of long-term returns for us, which is what's really important. But also we understand the short term is important as well. And year to date, we're very pleased to note that you can see there whilst the market is down 20% this year, we're only down 10% in US dollars. We're actually hitting all-time new highs in sterling, and we are in the top 1% of all global equity funds out of a 7,000 fund global equity peer group this year, which is really a pleasing result for us. And also over 7 years, that puts us in the top 2% of all global equity funds worldwide. So those are numbers that we're very pleased with. But as you can see, sort of middle of the pack around the 3-year number. And that is because of that drag on relative performance due to the pandemic, which I will go into later in the presentation. So first of all, I'd just like to point out some trends we've seen in the market, and what I think has been a real feature of the market over the last 10 years, of course, is the outperformance of the US. Now, this has been driven by they are able to demonstrate superior earnings growth. But I think what you can see is if you have a look at that 2020 to 21 period in that blue line, that line really does go up really quite sharply. And it was driven by a lot of technology related stocks during the pandemic. There was a lot of euphoria in that part of the market, and that was also reflected in valuations. You can see there in contrast, the Europe, which is the black line, and emerging markets, which is the orange line, underperformed dramatically over the past decade. Now, what's really interesting is these things do change. It's hard to imagine a situation now where the US isn't outperforming, but if we looked at the world market back in 1989, Japan, for example, was 40% of the world market, and today it's just 5%. Today, you're looking at the US being 70% of the global equity market. So if you're buying into a passive fund, for example, that tracks the global equity market, that's what you're buying into, 70% US exposure. The last time the US actually underperformed the rest of the world was in that period from 2000 to 2007, where you're coming off the back of the NASDAQ bubble and you had the resulting commodity boom. So it's been a long time since we've seen this trend reverse, and we're not looking at trends in particular when we're building portfolios. It's built on a bottom-up basis, which means we're just selecting the best companies we deem fit for the portfolio at any time. But it's interesting to see how that is reflected in terms of valuations also. So if I evidence that here, then this is just a price to sales ratio. So it's a valuation measure of the S&P 500, just the US. And what I want to show here is I've got the black line across the middle and the orange line there further up. And the black line is the average across the period. So we're going all the way back to August 1992. The orange line there just shows where we were in 2000. So if you look on the left side of the picture, and versus where we are today. And if you have a look during 2020, 2021, of the valuations of the S&P on this measure were far exceeding where we were in 2000. And that definitely was bubble territory back then. So what, as I've called the slide, US market went from extreme to expensive. That really is what happened on this measure. So we were far above where we were 2000. You can see on that orange line, all we've done is come straight back to where we were in 2000. That's with a 20% pullback in the S&P. And you can see, if you look very carefully on the right-hand side of the picture, you can just see that little rebound in the market on the far right. And that was the rally we had through July. So it's come down from very elevated levels. But the good news is, and what we'll highlight in the presentation, is we've seen some real dislocations in certain parts of the market. So yes, on a headline number, the S&P came back 20% in the first half of this year, but certain sectors of the market that were, perhaps even more expensive than this, really did suffer quite notable drawdowns. Parts of the US software market, for example, medical technology parts of the market, and there we're starting to see some really exciting opportunities. But what I just wanted to say is, when you're seeing scenarios like this, and when you can see that line there looking so far above where we were in 2000 and above historical averages, I think we just have to bear in mind the starting point at which you're at for valuations, and therefore your return expectations going forward. And so that's what I really wanted to highlight here when we drill down into high quality companies. So of course, when we're building our portfolio, we're doing things how we always have done when Peter set out over a decade ago now. We're building a global portfolio of quality companies that are able to demonstrate sustainable earnings growth over the very long term, great operating margins, very strong balance sheets, good economic moats, good management teams, low capital expenditure. These are all some of the things that we're looking at when we define a high quality company, when we're building our portfolio of 25 to 35 names. And what I've done here is I've taken a basket of 50 of what we consider to be exceptional high quality companies, but with no valuation overlay. And I've shown a valuation chart of what would have happened to those companies on a price earnings basis over the past 10 years. And I just want to highlight there, so the orange line is the average, and where we got to by the end of 2021. I mean, we're looking at almost 32 times on forward price earnings ratio basis for that basket of companies. And if you were to look through into that, you can see the components of it would be the likes of Amazon. You've got IDEX Laboratories, which is a world leader in pet healthcare. You've got Edwards Life Sciences, which is heart valve replacement technology. These are exceptional companies, but they're trading on 50, 60, 70, even 80 times forward price earnings ratios. So they got exceptionally expensive. And for us, we want to buy and build a high quality portfolio, but we don't want to overpay for it. We want to pay what we think is a fair price for those companies. And so if you can look at that chart and you can see where the chart really did get very expensive on valuation measures, our unwillingness to participate in that euphoria, if you like, for in particular growth companies during that period was a relative drag for us in terms of performance. But now what we're seeing, and that pullback on that chart, by the way, would amount to many companies within this list halving, which is where we stand out from a lot of our competitors this year. You know, we've held up a lot better in the downturn because we weren't joining that euphoria towards the end of last year. So we've been able to protect very much on the downside. And now the good news is we're seeing these large pullbacks and we're starting to be able to build positions in some of these high quality companies that we've been patiently waiting for. So what I wanted to do here is illustrate what happens if you do not have valuation support, and also the fundamentals as well, what can happen. And so when I was here in February earlier this year, during our roadshow, I talked about the NASDAQ. It had been really the hot place to be, if you like, in the market over the previous 2 years, and indeed actually quite a time before. But what many investors didn't actually know was that 40% of the companies in the NASDAQ have no earnings at all. And we got to a point in time in the middle of this year where half of the companies in the NASDAQ had fallen more than 50% from their highs. And what's even scarier, in my opinion, is almost 25% had fallen 80% from their highs, which I think is just staggering. So on this list here, many of these companies make this up, and you'll see at the top a lot of your pandemic beneficiaries. So companies like Peloton, Teladoc, which is online healthcare. You've got Carvana, which is online secondhand cars, Wayfair, your e-commerce, Zoom, of course. They all did exceptionally well in the pandemic. Some of these companies went 2-3x, but many of them are loss-making. They don't have the high-quality fundamentals that we really need to be able to invest in them in our strategy. And you can just see here, these pullbacks are staggering, 80 to 90% plus pullbacks. And this is done, this chart, in the middle of August. So it's actually after we had the July bounce. And so, you know, mathematically, you've got to ask yourself, if a company has lost 90% of its value, you're now having to make up 1,000% return to get back to where it was before. So you've got to ask yourself, what is the potential of that company actually being able to achieve that? So, you know, staying away from this collection of these pullbacks is something. It's permanent loss of capital, and it's something that we really strive to avoid and have avoided. You can see down the bottom of the chart there just a couple of companies that are highlighted black. These are companies that we own in the portfolio. Intuit we actually bought after a 50% pullback, and so we're up in that position when the company is down over 35% now year to date. SAP and Microsoft we've been adding to very recently. Microsoft, of course, you'll know, has been in the portfolios for 10 years plus. And so it's a long-term, very high-quality company that we're really excited about going forward. And we're always guided by our assessment of intrinsic value. So if we see pullbacks in high-quality companies, we're going to take those as opportunities to build those positions where we see a margin of safety to our fair value. So here's Intuit, and it's a really great example of how we operate on our team. So this is a new company bought in just in June this year. You can see in that circle on the right-hand side of the screen, that just shows where we bought into it. The circle on the left, the orange circle on the left-hand side of the chart, just shows where the valuation was relative to where it plunged to in March 2020. So we're just trying to illustrate that on a price earnings basis, the company is at a very good valuation level compared to recent history. So Intuit does online accounting software for small businesses. Its main brand is called QuickBooks. It also has TurboTax, which is tax submission over in the US. It has MailChimp, which is mail marketing, and it also has Credit Karma, a number of other small things. But what it's done is it's created an ecosystem. So if you're a customer of Intuit, you can use all of these different services and it'll charge you for it. I hear really topical at the minute, people asking me about how your company is going to handle inflation. Well, Intuit in their recent results have managed to put their prices up 20%. They're still growing their customer base. So, they're very, very well protected against that. And what you can see here in this high quality company, it's got a very good balance sheet. It's got close to 40% operating margins. We're forecasting its earnings to grow 13% compound over the next 10 years. And you can see there on the black line that the earnings per share, so it's just 1 year forward, earnings per share has gone from 8 to 16 over the last 3.5 years. So that's your earnings power up over 100% in the last 3.5 years. So it's phenomenal earnings growth. And this is the kind of company that we really, really want to own, to buy and to own forever. But as you can see, at the end of 2021, it got really, really expensive. So we were on almost 58 times forward price earnings ratio. So that's the scale on the right-hand side. It got exceptionally expensive. We've said baby thrown out in the bathwater. So at the end of last year, the market started to get really concerned about rising interest rates, inflation, and we started to see that sell-off really cascade, and Intuit got caught up in that. And so it almost halved when we were able to buy into the position. And now, if we look at it, it's actually one of our top contributors to returns this year. Just in contrast, I want to show you a company that we've actually sold last year. This is Oracle. It's a software company. You can see on first glance, if you look at the gray line again, you can see that trajectory of earnings growth. And indeed, it has managed to grow its earnings well over time. But Oracle's a good example for us of what makes us sell a business. And for us, those are two things. That's valuation. So if a company is very overvalued, or it's a breakdown in fundamentals. And Oracle kind of ticked both of those boxes when we sold it. We held it for 8 years, and eventually it did exceptionally well for us. You can see that the blue line, the forward price earnings ratio, it did have a large re-rating due to the middle of June 21. But the problem for Oracle is they were forcing this growth through stock buybacks, and they made their balance sheet incredibly indebted in the process. So by the time we sold Oracle, and they also did an acquisition, which we weren't happy with, but they had $78 billion of debt on their balance sheet by the time they sold Oracle. So that's not something we want to have in the fund. When we buy a new company in the fund, we're always looking to improve the quality and growth aspects of the portfolio as a whole. And so Oracle for us, it did exceptionally well. It took a while. It took 8 years for the company to outperform, but we have a long-term time horizon, so that's okay. But we did very well in the name, and we eventually exited it in June 21. It's pulled back substantially since. So here I just wanted to evidence this concept of improving the quality and growth for the fund. You can see on the left side here some of the companies that we've sold over the last sort of year, 18-month period. Company like Danone, of course, you'll know for their yogurts, their bottled water. We were worried about the impact of inflation on that company. We weren't seeing the growth in their water division. It was actually up 17% for the year when we sold it, and we bought into Samsung. Exceptional company. We sold it actually, held it for, we sold it at the end of an 80% rally moving into January 2021. We've managed to buy it back. So when we sell a great company, it goes onto our watch list. And if we have that margin of safety, we'll buy it back. And so that's what we did with Samsung. It's got $89 billion of net cash on its balance sheet. So it's got a phenomenal arsenal of cash to be able to continue doing what it's doing, which is really a leader in the memory market. We've got, you can see us selling Oracle on the left side there. We bought London Stock Exchange. It's on the world's largest fixed income trading platforms, but more importantly, it's got this Refinitiv is part of its business, which is data provision. And so it's 70% recurring revenue, which we really, really like. It's got a small amount of debt from this acquisition, but we're very happy with the acquisition. And we anticipate that it will have paid that debt down within around a year's time. So we're very happy with this business. Very happy to have had the opportunity to buy into what is an exceptional high quality business. You'll see there are a couple of our Chinese names, which I'll talk about later in the presentation. $13 billion of net cash. Our companies in emerging markets, we're really, really careful with making sure that they are of the highest quality. You'll see Visa there. We sold Bookings Holdings. We actually sold it just before the news of the Omicron variant came out worldwide. And again, we were guided by intrinsic value. We sold it around $2,500. It's now $1,800 today. And we bought into Visa, which is a company that we have had for a very, very long time. We were able to build that position at the end of November, 60% operating margins, fantastic balance sheet. And then you'll also see Intuit there at the bottom. So in summary, our new positions, if you look at our portfolio as a whole, have got $85 billion in net cash, and many of them even, continuing to improve their balance sheets. And that's moved from a net debt position of 153 billion. So you can really see the quality of the portfolio improving over time. So in summary, what that looks like is if you look at the many quality factors here, like return on equity, operating margins for our portfolio as a whole, all of our companies in our portfolio, you can see there 22% versus the MSCI World at 16, 27% operating margins versus the MSCI World at 14, far stronger balance sheets if you look at it on a net debt to EBITDA basis versus the MSCI World. But I just want to point out here that on a valuation basis, we are paying about 6.6% free cash flow yield for our companies in the portfolio on average. Which is about the same as the MSCI World Index, the global equity market. So what you're doing is you're getting a collection of 33 holdings, which we have exceptional conviction in their ability to grow faster than the market over the long term at much higher quality than the market, but for the same valuation. So these are the things we're really looking to achieve when we build the portfolio. So the second half of the presentation, I just want to talk about some more macro trends we've seen in the market. I think that this is a really, really interesting chart. And the UK bond market, if you look at it in US dollars, has suffered a spectacular collapse. I mean, I hear people saying to me often, like, Hannah, some of the the collapses you've seen in the equity market, but actually, parts of the bond market are looking far, far worse. And I was talking to some clients yesterday just about the 60-40 portfolio concept. So, 60% equities, 40% bonds. So we put it as having the worst year in history. But UK gilts total return, and I just want to show this chart here, you would have lost 33% drawdown from the highs if you look at it in US dollars, and you are 20% down in US dollars from 2015 in a perceived safe asset, which is really, really quite staggering, the pullback you've had in that part of the market. So I just want to take you through some of the top holdings in the fund. This is our recent snapshot of our top 10 in our portfolio. You'll see there, and what Alvin often speaks about too, is the diversification within global equity portfolios, within equity portfolios. And you'll see there, you've got a combination, you've got one of the biggest tobacco companies in the world. You've got Fiserv, which does your ledger technology for your banks. It's one of the real leaders in what it does. It's a fintech business. You've got London Stock Exchange Group, which, like I said, is one of the largest fixed income trading platforms in the world. General Dynamics, which is a leading defense company. It's really fantastic in this environment. It's perceived slow grower, but it has very, very long-term inflation protected contracts. And of course, has been a beneficiary of the war in Ukraine. So that's done exceptionally well for us, building the position from the middle of 2019 up to today. So we're very pleased with that. And Alphabet, a company that is actually one of our top contributors two returns since we bought it back in 2015. We've continued to maintain that position around 4% of the fund. It's been a bit weaker this year, but actually over the long term, it's done exceptionally well for us. So this is a chart that shows the average price earnings ratio for the top 10 companies in our portfolio. And what I want to do is draw your mind back to the chart that I showed earlier in the presentation that showed the valuation of a group of high quality companies. If we completely ignored our valuation overlay, remember that group of 50 stocks and how it got from about 14 times forward price earnings ratio up to over 30 times forward price earnings ratio during the end of 2021. And in comparison, what you can see here, if you look at the scale, you can see that scale is much tighter. You can see that scale is only going between about 14 times and 18 to 19 times. So it's much tighter scale. And so what that evidence is when we're keeping our valuation discipline in our portfolio, being really careful about what we pay for high quality companies when we bring them into the portfolio. You can see that you can see the re-rating slightly through 2020 through to February 2021, but we've really managed to keep that valuation stable, and that's really helped us this year when many parts of the market that got a lot more expensive have sold off quite dramatically. I just wanted to touch on Elevance Health quickly because it's the largest position in our portfolio. You may well know it's Anthem. You can see here that we bought into it here on the orange circle back in around August 2020. Elevance is one of the largest health insurers in the US. The other one is of course United Health. We bought into Elevance when the market was quite concerned about health insurance businesses and the impact that COVID would have on it, and you can see that pullback in valuation there just towards sort of the middle of the year in 2020. In summary, Elevance has been an exceptional performer for us. You can see there the earnings per share growth. That's forward 1 year forward earnings per share on the black lines increased by 75% over the past 5 years. But the company hasn't really got too much more expensive. You can actually see on absolute terms. It's moved from about 11 times forward price earnings ratio to around 14. So in absolute terms, it's not an optically expensive company. And we do combine more expensive companies in the portfolio like Intuit, like Visa, with companies like this. But you can see it's offered us exceptional earnings growth over the past few years. And if you actually look back from where we entered the position, we're up 75% in that name. It continues to be the top holding in our fund. Employers are now very worried about making sure that their employees are covered. And so you can see them there. They've been doing very well, executing very well in their results, which we're really pleased about. So if we just draw back to looking at the market overall and some different areas in the market, this looks a bit back to where we were at the first slide, where we showed the outperformance of the US versus the rest of the world. And this just goes back all the way to 2002. And what I want you to do is look at the blue line. So the blue line shows whether you're at a premium or a discount for the US against the rest of the world. So the rest of the world is in the black and the US is in the orange. And you can see there, if you look back in around 2005, 2006, the rest of the world was really trading at a premium against the US. And you can see there that premium has gone to almost a 30% premium to a 40% discount now. And you can see that reflected in the US there. If you have a look at the long-term price earnings ratio, so that's price over 10-year average earnings, to just try and smooth out some of the extremes you've seen in the market more recently, you can see that we're at almost 39 times at the peak PE ratio for the US. So it did get exceptionally expensive versus the rest of the world. And so now you're seeing there, we've actually gone from a 40% discount to a 30% discount for the US, but there's a long way to go for the rest of the world to catch up with that. But the good news is that means that we're starting to see opportunities in the rest of the world, which is reflected in our portfolio. I just want to show that here quickly. So, I mean, we don't care so much about where a company is listed. We like to look at where it generates its revenue. And you can see there that about 42% of the revenue generated within the companies in our portfolio is in the US. But what I wanted to point out is emerging markets exposure, which is actually, if you add all add it all up on the right side there, it's over 30%. So we're looking to those areas of the world where we can see the growth, we can see the opportunities there. And so that's really exciting for us. And you can see here, this is just one of the examples that we've put in, which is NetEase. It's a Chinese gaming company. At the minute, about 4 to 5% of its revenue is international revenue. Is almost entirely China currently, the rest of it. But they're looking to move that revenue to around 30% over the future. So they've just made an acquisition in Europe. I'm really excited about. They have games like Harry Potter and Diablo Immortal, which are very big apparently in the gaming community. But you can see there that where we bought into the position in around June, July time last year with our orange liners, we can continue to see the earnings growth by the company, and that valuation has really managed to stay very stable. So we're about flat in that name since we bought into that position, but the market is down over 10% from there. So on a relative basis, it is outperforming since we bought it. However, we're looking very much into the long-term prospects of this company as it builds out its international exposure through its leading games. So our Chinese exposure for us was a drag actually for us on the portfolio for much of last year. We really started to build it around the middle of last year through companies like NetEase. We started to build our positions again in Tencent, for example, also Alibaba. Through all the regulatory consternation that we saw in China, we did see that dramatic pullback, and you can see that there on the black line, and you can see the real difference in outperformance of the US there going completely in the opposite direction as it vastly outperformed. However, for us, I mean, we saw a big reversal of that in Q2 this year, which is part of what helped contribute to our outperformance. You can see is particularly the large cap names in the US started to cave at the start of this year. You saw the S&P really start to sell off in the first part of this year. And during that time, there was a 20% outperformance of China, which really helped us on a relative basis. For now, we have names like Yum China, which we're really excited about, which is KFC China. They're going to be building out into over 2,000 cities, which yet to have KFC presence. They have an exceptional balance sheet. They have $15 billion of net cash. And so we're very much looking forward to the prospects of this company growing at over 1,000 restaurants in China over the next 5 to 10 years. We have companies like NetEase also with their gaming, which they're really building out. So that alongside the Chinese exposure we have through on a revenue basis, the rest of the rest of our portfolio, what we're doing is we're accessing faster growth, but at much better valuations than what we have seen in many parts of the US and Europe. So just to conclude, we have a slide here called Patients Will Be Rewarded. We have 3 exceptional high quality companies here. Intuitive Surgical have their Da Vinci technology, which is minimal invasion technology. Edwards Life Sciences is transcatheter aortic heart valve replacements. And IDEX Laboratories, like I said earlier, is the leader in animal healthcare. And these are companies that we would love to own in the future, but we can see they have had dramatic pullbacks this year, between 30 and 50% for these companies. But what that's actually done is taken you on a valuation basis from 80 times forward price earnings ratio to 40 times. And so, yes, that's a big difference from where we were. But in terms of history, you can see there, if I just highlight IDEX for an example, compared to where it was in sort of 14, 15, we're still at elevated levels. And in an absolute basis, it's more than twice as expensive as the market. And so patients will be rewarded, but we just don't think we're quite there for many businesses that came from such an exceptionally high base. They have pulled back, yes, but we're looking forward, hopefully, to be able to get an opportunity in some of these names when they pull back to a more reasonable value. We have a chart here called There Is Always Something to Worry About. You can see that consumer confidence heading down. I was reading this morning about how household disposable income year-on-year change is in the worst position it's been in since 1975. I can see US mortgage applications at a 20-year low. I don't wish to be overly negative. I mean, the market is always forward-looking. So for us, what that's trying to say to us is what is already reflected in prices, and we think there may be a bit further to go yet if we look at those high quality companies, but we're looking to build positions in those names where we see opportunities. And you can see here a chart about improving the long-term return prospects of the market, and in the context of where we've seen pullbacks in the past. So you can see the second worst performance of the S&P actually going all the way back in history. The only one worse is 1970, which is only 1% worse. So yes, it looks quite extreme when you put it in this context, but like I said, we've done very well on protected on the downside so far this year, and we're looking where we see opportunities in those companies to be able to build them at more reasonable valuations, and we are therefore looking to improve our return prospects going forward. Lastly, I just want to say this quick chart about inflation, and we've got here the S&P 500 versus long bonds, and you can see there that even when you have a 20% pullback in the S&P, it's still outperformed long bonds. So in an inflationary environment, and you've seen that huge collapse in the bond market, we still believe that the equity market is the place to be for us as equity investors. So just to summarize here, we've written that quality investing has delivered and chasing trends has not, and we are very pleased to be in the top 11% over a 1 year basis versus our overall peer group. And I think that part of what helped us to do that is that many parts of the market got sucked into the euphoria that you saw post-pandemic, and it was difficult for us to not get blinded by that. But we are very, very much committed to our investment philosophy, to investing in the way that we said that we always would for our clients, and we continue to do so. And we believe that so far this year that patience has been rewarded, but we will continue to invest in the way that we said we would, and over the long term that's worked out very well for us. So we look forward to being able to continue to do the same again. Thank you. So with that conclusion, thank you very much for listening to myself and Alvain today. It's been a pleasure to speak to you. If you have any questions, queries or concerns, please do not hesitate to reach out to us and speak to your portfolio manager. We're always very happy to answer any questions you may have. And until next time, thank you very much.